Hello, welcome. In this video, we will look at acquisition accounting for ACCA SBR group accounting basic groups. The acquisition accounting has following four requirements, which includes identifying the acquirer, determining the acquisition date, recognizing and measuring subsidiaries' identifiable net assets, recognizing goodwill, and NCI. Identifying the acquirer. When identifying the acquirer is normally the entity that has transferred cash or other assets within the business combination. If the business combination has not involved the transfer of cash, then the acquirer is usually the entity that issues its equity interest. The acquirer is usually the bigger entity. The acquirer is usually the entity whose owners have the largest portion of voting rights in the combined entity, and the acquirer is usually the entity whose former management dominates the combined entity. Determining the acquisition date. The acquisition date is the date on which the acquirer obtains control over the acquiree. The acquisition date will be the date at which goodwill must be calculated, and from which the income and expenses of the acquiree will be consolidated. Recognizing and measuring subsidiaries' identifiable assets and liabilities. The acquirer must measure identifiable assets acquired and liabilities assumed at their fair value at the acquisition date. Identifiable assets. An asset is identifiable if it is capable of disposal separately from the business owning it, or it arises from contractual or other legal rights, regardless of whether those rights can be sold separately. Example: an internally generated brand name but not goodwill recognized in subsidiaries' financial statements. Recognized at fair value, where they meet definitions of assets and liabilities. They are exchanged as part of business combination rather than a separate transaction. Watch out for the following items: contingent liabilities, recognized at fair value at the acquisition date. Fair value incorporate probability of an economic outflow. Provisions: restructuring costs only recognized if exist at the date of acquisition, but not future operating losses as it relates to post-acquisition. Intangible assets are recognized, which include brand names, but goodwills are not recognized. Assets and liabilities falling within the scope of the following standards should be valued according to those standards. When calculating goodwill, purchase consideration transferred to acquire control of the subsidiary must be measured at fair value. When calculating goodwill, contingent consideration is included even if the payment is not deemed probable. Its fair value will incorporate probability of payment occurring. Legal and professional fees are expensed to P&L as incurred. Debt and equity issue costs are accounted for in accordance with IFRS 9 financial instruments. When calculating goodwill, replacement share-based payment schemes exchanged for share-based payment schemes held by the subsidiary's employees. The fair value of the replacement scheme must be allocated between purchase consideration and post-acquisition remuneration expense. The amount allocated as purchase consideration cannot exceed the value of original share scheme at the date of acquisition. The amount attributable to post-acquisition service is recognized in accordance with IFRS 2 share-based payments. When calculating goodwill, bargain purchase, that negative goodwill is rare and may suggest that errors were made when determining the fair value of the consideration transferred and the net asset acquired. The figures should be reviewed for accuracy. If no errors have been made, the negative goodwill is credited immediately to P&L. When calculating goodwill, measurement period ends no later than 12 months after the acquisition date. During the measurement period, the acquirer in a business combination adjusts retrospectively the provisional amounts recognized at the acquisition date to reflect new information obtained about facts and circumstances that existed as of acquisition date. This would result in goodwill arising on acquisition being recalculated. When calculating goodwill, if the NCI is valued at acquisition as their proportionate share of the acquisition net assets, then only the acquirer's goodwill will be calculated. If NCI is valued at acquisition at fair value, then goodwill attributable to both acquirer and NCI will be calculated, and this is known as full goodwill method. When calculating goodwill, impairment of goodwill requires that goodwill is tested for impairment annually. So this is the definition of CGU, or cash generating unit. And this is definition of impairment loss. And this is the definition of recoverable amount. Impairment losses on a subsidiary will firstly be allocated against goodwill and then against other assets in a CGU on a pro rata basis. Impairment of goodwill. If NCI is calculated at fair value method, full goodwill method, goodwill can therefore be added together with other net assets of subsidiary and compared to recoverable amount of the subsidiary's net assets. Any impairment is allocated between the group and NCI. If impairment of goodwill is NCI proportionate method, any comparison between the carrying amount of subsidiary, including goodwill, and the recoverable amount of its net assets will not be on a like-for-like basis. Goodwill must be grossed up to include goodwill attributable to NCI prior to conducting impairment review, and this grossed up goodwill is known as total notional goodwill. As only the parent's share of goodwill is recognized in the group accounts, only the parent's share of goodwill impairment loss should be recognized. Exemptions from consolidation. Intermediate parent companies, provided all conditions are met. It is a wholly owned or partially owned subsidiary where owners of NCI do not object to non-preparation. Its debt or equity instruments are not currently traded in a domestic or foreign market. It is not in the process of having any of its debt or equity instruments traded on a domestic or foreign market. The ultimate parent entity produces consolidated financial statements that comply with IFRS standards and which are available to the public. If this is the case, IAS 27 separate FS requires that the following disclosures are made. The fact that consolidated FS have not been presented, a list of significant investments, which include subsidiary, joint ventures, and associates, including percentage, shareholdings, principal place of business, and country of incorporation. The basis on which those investments listed above have been accounted for in its separate FS. Investment entities do not consolidate an investment over which they have control. Instead, the investment is measured at fair value at each reporting date with gains and losses recorded in P&L. They invest those funds to earn returns from capital appreciation, investment income, or both. Obtains funds from investors and provides them with investment management services and measures the performance of its investments on a fair value basis. Disclosure of interest in other entities. There needs to be disclosure of significant assumptions and judgments made in determining whether an investor has control, joint control, or significant influence over an investee. Disclosure of the nature, extent, and financial effects of its interest in joint arrangements and associates. Additional disclosures relating to subsidiaries with non-controlling interests, joint arrangements, and associates that are individually material. Significant restrictions on the ability of the parent to access and use the assets or to sell the liabilities of its subsidiaries. That's all for this video. I hope this explanation was helpful. Thank you for watching. There is a disclaimer, please read it.